We are not here to predict the exact day the system breaks. We are here to tell you that the conditions for a major global economic crisis in 2026 are already in place. If you are an investor, ignoring these signals will cost you most of your portfolio. This is not a drill. This is the moment your risk management either works or fails. Start with debt. Global debt has reached levels no modern economy has ever seen. Governments, corporations, and households have been borrowing for decades under the assumption that rates would stay low and growth would continue. That assumption is dead. The United States government debt has crossed levels that make interest payments one of the largest budget items, exceeding defense spending. Every day the debt grows, and every increase in rates makes the burden heavier. This is not sustainable. It will resolve in one of three ways: default, inflation, or austerity. None are good for investors holding dollar-based assets. The corporate side is equally dangerous. Years of cheap money led to excessive leverage, share buybacks, and weak balance sheets. Many companies survived only because central banks kept liquidity flowing. Now liquidity is tightening. Refinancing costs are rising. Defaults are picking up, especially in high-yield and private credit markets. The private credit space, which expanded massively after 2008, is facing a liquidity crunch. Funds are locking up investor money, redemptions are being restricted, and underlying assets are marking down. This is a slow-motion collapse that will accelerate in 2026. Equity markets have been living on AI hype and hope. Valuations in major indexes are stretched beyond historical averages, driven by a small group of large-cap tech names. The narrative is that AI will drive endless growth, margins will expand, and profits will catch up to stock prices. That narrative is cracking. AI spending is real, but returns are delayed. Many projects will fail. Layoffs are already spreading across tech. When sentiment shifts, these stocks will correct violently. The bubble is not in tech itself, but in the expectation that every AI investment will succeed. That expectation will be destroyed in 2026. Inflation has not been defeated. It has been suppressed. Supply chain normalization and rate hikes slowed it. But structural drivers remain: energy volatility, geopolitical tensions, labor costs, and ongoing currency dilution. Any new shock: conflict in the Middle East, oil supply disruption, extreme weather can reignite inflation quickly. Central banks will be forced to choose between fighting inflation and supporting growth. They cannot do both. The result will be higher volatility, slower growth, and a market that prices in persistent inflation risk. Geopolitical risk is no longer a tail event. It is a core risk. Conflicts are multiplying. Trade blocs are forming, and globalization is reversing. Supply chains are being regionalized, not optimized for cost. Tariffs and sanctions are becoming standard tools. This raises costs, reduces efficiency, and creates constant uncertainty. Investors who ignore geopolitics will be blindsided by sudden market moves driven by headlines, sanctions, or supply disruptions. Currency instability is accelerating. The dollar's dominance is not ending overnight, but its reliability as a safe haven currency is being questioned. Other nations are diversifying reserves, settling trade in alternative currencies, and building parallel payment systems. This process will not replace the dollar in 2026, but it will increase volatility in currency and bond markets. For investors, this means traditional safe assets like long-term government bonds are no longer risk-free. They carry inflation risk, rate risk, and currency risk. Real estate markets are under pressure. Residential and commercial sectors face different but related problems: high prices, high debt, rising rates, and weakening demand. Commercial real estate is already struggling with vacancies and refinancing risks. Residential markets are slowing as affordability drops. A real estate correction will hit banks, developers, and consumers. It will reduce wealth, slow consumption, and amplify recession risks. Banking system vulnerabilities are rising. Many banks hold large portfolios of long-duration bonds and real estate loans. When rates rise, those assets lose value. When defaults rise, capital erodes, banks will tighten lending standards, making credit harder to get for businesses and consumers. A credit crunch will deepen any downturn. Investors need to understand that banking stress is not isolated, it spreads through the entire economy. Now, what does this mean for you as an investor? Survival in 2026 is not about making huge gains. It is about avoiding permanent loss. The rules that worked in the last decade by the dip, hold tech, ignore risk will not work. You need a new playbook. First, prioritize liquidity. Cash is not trash in a crisis. Cash gives you options. It lets you meet margin calls, cover living expenses, and buy assets when prices collapse. Keep enough cash outside illiquid funds. Avoid locking money in private funds with long lockup periods. Liquidity is your first line of defense. Second, reduce leverage. Debt magnifies gains in good times and destroys you in bad times. Margin loans, real estate mortgages, business loans, any leverage becomes dangerous when asset prices fall and income slows. Pay down high-cost debt. Avoid new leverage. If you must use leverage, keep it minimal and short-term. Third, rebalance away from overvalued assets. Tech stocks with stretched valuations, meme stocks, crypto assets with no real utility, these will suffer most in a crisis. You do not need to sell everything, but you need to reduce exposure. Shift from speculative growth to quality companies with strong cash flow, low debt, and pricing power. Fourth, own hard assets. Physical assets that hold value when paper assets crash. Gold and silver are classic stores of value. They preserve purchasing power when currencies depreciate. Industrial metals like copper have both monetary and industrial demand, especially in energy transition. Real assets like land, select real estate, and infrastructure can provide inflation protection and income. Hard assets are not speculation, they are insurance. Fifth, focus on quality income. In a crisis, dividends and interest payments become more important than capital gains. Look for companies with a history of stable dividends, low payout ratios, and resilient businesses. Avoid high-yield bonds that rely on unstable cash flow. Prioritize investment-grade debt and select emerging market debt with strong fundamentals. Income will buffer your portfolio when prices fall. Sixth, understand sector rotation. Some sectors hold up better in a downturn: utilities, consumer staples, healthcare, defense. These are defensive sectors with consistent demand. Avoid cyclical sectors like luxury goods, construction, and highly leveraged industrials. Be selective with energy. It can be volatile but benefits from supply constraints and inflation. Seventh, diversify geographically. The crisis will not hit all regions equally. Some economies have stronger balance sheets, lower debt, and more policy flexibility. Avoid overconcentration in one country or currency. Consider exposure to markets with resilient domestic demand, stable currencies, and sound banking systems. Diversification reduces risk. It does not eliminate it, but it prevents total ruin. Eighth, stay disciplined and patient. Markets will swing wildly. There will be rallies that feel like the worst is over. Do not chase those rallies. Do not buy into the narrative that the Fed will save us. The Fed has limited tools when inflation is sticky and debt is unsustainable. Patience lets you wait for real opportunities, not fake ones. Ninth, monitor key signals. Watch bond yields, especially long-term rates. Watch credit spreads. Widening spreads signal stress. Watch liquidity conditions in funding markets. Watch inflation data and central bank rhetoric. Watch geopolitical developments and energy prices. These signals will tell you when risk is rising and when to adjust your portfolio. 10th, prepare mentally and financially. A crisis is emotional. Fear and greed drive bad decisions. Have a plan before the crisis hits. Know what you will sell, what you will hold, and what you will buy at specific price levels. Build an emergency fund separate from investments. Reduce living expenses where possible. Mental preparation means accepting that losses will happen, but ruin is optional. 2026 will be a year of upheaval. Markets will fall. Volatility will spike. and many investors will lose everything. But for those who understand the risks, prepare early, and follow a disciplined strategy, it will also be a year of opportunity. The best assets go on sale during crises. The key is to survive until that moment. You are not powerless. You can protect your wealth. You can position yourself for the recovery that will come after the crisis. But you must act now. Waiting until the storm hits is too late. If you found this analysis clear, actionable, and unfiltered, subscribe to the channel. Hit the bell so you do not miss the next updates on crisis signals, asset allocation, and the shifting global order. Leave a comment below. What is your biggest concern for 2026? What are you doing to prepare? Let's build a community of informed investors who survive and thrive when others panic.